Welcome back to the Global Ledger. I'm Justin. A lot of people believe the central bank directly controls the economy. They imagine levers being pulled that raise wages, lower rents, create jobs, or slow inflation in a straight line. But that's not how the system actually works. In reality, the central bank doesn't target the economy directly. It targets markets. And it does so for a very simple reason. Markets are where monetary policy can actually operate. Today, we're going to explain why the economy itself is not directly controllable, why markets are the transmission mechanism, how financial conditions sit between policy and real outcomes, and why this distinction explains so much confusion around central banking. Let's get into it. Let's start with the obvious limitation. The economy is vast, decentralized, heterogeneous, and slow-moving. Millions of businesses, hundreds of millions of households, countless contracts, prices, and decisions. There is no central switch that controls all of that. Even fiscal policy, which directly spends and taxes, operates with delays, leakages, and political constraints. Monetary policy is even more indirect. It cannot force people to spend, force firms to hire, or force prices to adjust on command. So policymakers focus on the layer they can influence. Markets are different. Markets are centralized. They're fast-moving, continuously priced, and deeply sensitive to funding conditions. Interest rates, credit spreads, asset prices, liquidity, so on and so forth. These are the places where policy decisions immediately register. When a central bank changes administered rates or balance sheet composition or communication, markets react within seconds. The economy reacts over months or years, so policy starts where feedback is fastest. Financial conditions are the transmission mechanism. This is a critical bridge. Between markets and the economy sit financial conditions. Financial conditions include borrowing costs, credit availability, asset valuations, risk appetite, and liquidity. When markets reprice, mortgages change. Corporate financing shifts, investment decisions adjust. Hiring plans evolve, right? But none of these happen instantly. Policy influences markets. Markets influence financial conditions. Financial conditions influence the economy. That's the chain, okay? It's not some switch. And why does this look like targeting markets? Well, because it is targeting markets. When policymakers talk about stabilizing those markets or restoring liquidity or maintaining orderly function, they're not choosing Wall Street over Main Street. They're protecting the plumbing that connects policy to the real economy. If markets break, credit stops flowing, pricing fails, right? Confidence collapses. At that point, the economy doesn't just slow, it fractures. So markets are stabilized not because they are the goal, but because they are the pathway. Extremely important difference there. And this creates public confusion. And here's why. The structure creates a perception gap. People see asset prices rising. They see markets recovering quickly, and they see liquidity returning fast, while wages lag and prices stay high and households feel pressure. And the conclusion becomes policy only helps markets. But what's really happening is markets adjust first, the economy adjusts later, and sometimes unevenly. That lag is not a failure of intent, it's a structural reality. And because policymakers are always reacting to data that reflects the past through tools that affect the future and via markets that move in the present. That timing mismatch is unavoidable, and this is kind of why policy often feels late or even wrong. If policy waited until economic pain was obvious everywhere, markets would already be broken. If policy responded only to markets, the economy might overheat or even cool unevenly. So policy lives in an uncomfortable middle ground, and that tension is kind of permanent. And this doesn't mean, however, that markets are the priority. This is important because targeting markets does not mean markets are more important than people or asset prices are the objective, or even inequality is ignored, right? It means markets are the only lever available at scale and speed. Everything else flows through them. That's, this isn't some moral obligation or I should say moral statement. It's strictly operational. And if we connect this to the series so far, let's take a step back and connect the architecture here, okay, and what this means. Administered rates shape short-term pricing. We've talked about that. Standing facilities are stabilizing funding markets. Balance sheet tools affect liquidity and risk. Forward guidance shapes expectations. Markets absorb all of this first. Only then does the economy respond. This is why understanding markets really is not optional whatsoever, in my opinion. Okay, they are not a sideshow. They are the transmission system, and that matters because if you expect monetary policy to directly fix housing costs or wages or prices, you will always be disappointed. If you understand that policy works through markets, financial conditions, and time, that system starts to make more sense. I want to thank you for listening to episode 57. We explain why central banks target financial markets instead of the economy itself. And I hope it was helpful. And if you found it helpful, please share it with somebody else that may be, this might confuse them a little bit. In the next episode, we're going to talk about financial conditions indexes, okay? So, and what they really measure. I think this will be great to add next to the series. So once again, I'm Justin, and thank you for being here.